Give us a sense of what the markets are doing. We also have some great charts that our Tracy Alloway over in Abu Dhabi put together, showing us that not all is right on the markets and we may be mispricing things.
You mean in terms of the markets have rallied quite a lot?
Right, or in terms, for example, the VIX index not doing much, but when you look at the fear index in Washington, it's high. So what are you looking at to give us a sense of the market direction?
I totally agree. You've got this environment where implied volatility measured by the VIX, all the other indices that measure that is incredibly low. And if you just looked entirely only at those indicators, you'd think everything was calm in the world, no risks at all. But then if you look at other indicators like policy uncertainty, political risk, they seem incredibly high. The opposite, in fact, of those implied volatility indicators, which are very, very low. So it would seem to us that the market, I think part of the problem is that investors find it very difficult to know which assets to invest in at the moment. Normally, if things were very, very risky, you go into bonds. But if the risk is partly how much inflation is created, do you really want to go into bonds? And then if you're worried about risks within equities, perhaps you'd like to go more defensive into high-yielding assets. But again, if you're worried that the risk is perhaps overheating, more growth, inflation, maybe driven by tax cuts.
So where do you see the main risk, Sharon?
I think there are several large risks. I mean, you mentioned one of them on your screen here with the China and the outflow data. That's clearly one risk. It's been ongoing for some time, probably the last couple of years that we've been seeing this. So it's perhaps not a risk which is on a short time scale, but that clearly is a risk. And then I mentioned politics. That's another very large risk. On both sides of the Atlantic, there's a lot of political uncertainty in the US in terms of how much of the reforms and proposed agendas by Trump, the Republican Party, will be passed through this year. And then there's the impact that will have on the market. And then within the context of Europe, which is my main focus, there's electoral risk in almost all the big countries this year. So plenty of risks.
Yeah, so let me bring you over, actually. So yesterday, Tom and I, for the first time in a very long time, I think it was the first time ever, Tom, a surveillance exclusive. We had the same chart on that French-German spread. How do you look at this? I know you look at equities, but actually it must also mean that there's a real risk that Marine Le Pen becomes president.
Yeah, I mean, that spread would still look tiny versus, say, the spread between Italy and Germany, or even Spain and Germany. But it's true, it's moved a lot. You're not back quite up to where those spreads were in the sovereign crisis period in 2012. Yeah. I think if you were back up to those levels, people would be genuinely worried about a breakup of the euro, as they were back then. But, you know, looking at that chart, you probably retraced half back up to where we were during those sovereign crisis periods. So clearly people see it as a very large risk. I mean, but this is also true of the consensus, don't expect Le Pen victory in the second round. But clearly the risks are there. And it's not just France.
Sharon, help me here with the reality of a 4 or 5% dividend in Europe. Tell me about fat dividends in Europe. Is that a good thing or is that a crutch for European equities?
I think, well, I mean, you could say that although the dividend yield is much lower in the US, they give money back via share buybacks. So, you know, whether share buybacks in the US or dividends in Europe is the better way to pay back money is questionable. But the sectors which are paying those 4 or 5% dividends are the sectors in Europe that most people would say are quite vulnerable to being able to maintain those dividends. So perhaps the banks, the insurance companies, the oil stocks, etc. So if you're paying 4, 5, 6% dividend yield, that almost certainly means the market is still worried about the vulnerability of that yield. The oil sector, for example, I mean, I wouldn't be too bearish on oil at the moment because I think OPEC production cuts have been quite well adhered to, etc. But the oil sector in Europe offers a 5.5% dividend yield with no free cash flow yield. So is that really safe?
Okay, then bring it over to what we're seeing with President Trump and the idea of multinationals in the United States as a proxy for global investment. Are multinationals, by definition that's true of Europe, are multinationals in Europe a proxy for global investment?
You mean the fact that multinationals are giving money back in dividends or share buybacks rather than doing investment on both sides of the Atlantic? I think there is a problem with investment growth. It has been very weak. In fact, the one thing that's picked up in terms of cash usage this year, particularly in Europe, has been M&A activity. So trying to use your cash to gain growth, perhaps non-organically by purchasing it rather than doing your own investment. So yeah, I think this has been, it's a bit like the sort of the capital outflows in China. It's the last probably several years, maybe even you could say decade, and certainly since the financial crisis, where we've had an ongoing problem where companies are unwilling to invest.